This question will walk through lessor accounting. On January 1st, 2020, Vic Leasing Inc., a lessor that uses IFRS 16, signed an agreement with River Rock Inc., a lessee, for the use of a compression system. The system cost $415,000 and Vic purchased it from Manufacturing Solutions Limited, specifically for Rock River Inc. Annual payments are made each January 1st by Rock River. In addition to making the lease payment, Rock River also reimburses Vic $4,000 each January 1st for a portion of the repairs and maintenance expenditures, which cost of Vic leasing a total of $7,000 per year. At the end of the 5-year agreement, the compression equipment will revert to Vic and is expected to have a residual value of $25,000, which is not guaranteed. Collectability of the rentals is reasonably predictable, and there are no important uncertainties surrounding the costs that have not yet been incurred by Vic Leasing. And the first thing we're asked to do is, it says assume that the Vic Leasing has a required rate of return of 8%. Calculate the amount of the lease payments that would be needed to generate this return on the agreement if payments were made each January 1st or December 31st. So let's calculate the lease payments that are required to generate this 8% rate of return. We're going to figure out if they're due at the beginning of the period or at the end of the period and how that impacts the calculation. So let's do the beginning of the period first. So we're going to have present value. They purchased the equipment. The equipment cost $415,000. So the original present value for us, the lessor, is $415,000 negative cash outflow. The interest rate is 8%. That's the required return that Vic has established. The term of this lease is 5 years. And the payment is what we're calculating. And the future value is going to be the residual value of $25,000. It's not guaranteed, but it's okay. We're still going to include it in our calculation because at the end of the term of the lease, Vic is still going to have, or we are still, as a lessor, we're still going to have equipment that we think is worth $25,000. So of course, we're going to have begin mode on for the beginning of the period. And our payments here are going to calculate out to be 92 to 94.46. Oops, 92. Okay. Now at the end of the payment, end of the period, we're going to have all the same inputs. But we're going to have begin mode off, because now the payments are due at the end of the period. And our payment here is going to be $99,678. So you can see that in order to generate this return, the lessor is going to need to make payments here of $99,000 and here of $92,000, because here the lessor gets paid that much faster. So there's less impact from the time value of money. Okay. So the next thing we're asked to do is assume that payments are due each January 1st. So we're in this scenario. Prepare all journal entries and for 2020, assuming that Vic has a calendar year end. Include the payment for the purchase of the equipment and leasing in your entries and the annual payment for repairs and maintenance expense. Okay, so let's use a lease amortization schedule here. So we are going to have So we're going to have the, so we're going to have the date, we're going to have the annual payment, we're going to have the interest, we're going to have the net investment recovery, and we're going to have the net investment. All right, so let me just expand this one. Okay, so we're going to have the date here is going to be, this is a 5-year lease and it was signed on January 1st, 2020. We're going to have January 1st, 2020 twice, January 1st, 2021, January 1st, 2023, January 1st, 2024, January 1st, 2025. So let me just see how many years we've got here. This is 6 and it's a 5-year lease, so we can get rid of 1. And we're going to have December 31st, 2024 is going to be the residual. Okay, so the original value of the lease for the lessor is the purchase. So we're going to have 415,000 as our original investment. Then we're going to have the annual payments here, which are going to be excluding the executory costs, which we had set for this amount. So we're going to pull these down all the way through. And then there's the guaranteed residual value. Not sure why that's happening. Okay. Okay. And there's the residual value here of, what was the residual value? 25,000. Even though it's not guaranteed, we're still going to include it here because for the lessor, we're going to have that at the end of the equipment. Here, there's going to be no interest accrued. So we're going to have this amount is going to be this minus this. And this is going to get pulled down just by the amount of the payment. Then here, January 1st, 2021, this is going to be our carrying value times our rate of interest, which is 8%. So we can pull that down. And we'll pull these numbers down and we'll pull this down. Okay, so if we fix the rounding here, we'll see that this schedule is working. We're at 0 at the end of the lease. So these will give us all the entries that we need. So we're asked to record, prepare the journal entries and adjusting entries. Okay, so let's get started here. So actually, sorry, we skipped over B. Use Excel to prepare an amortization schedule that shows how the lessor's net investment will be reduced if the payments are made each January 1st or December 31st. So here we've done, this is January 1st. And if we do December 31st, we are going to have the exact same schedule. But what's going to change is December 31st. So our lease payment's going to change because our lease payments here were 99,678. So we can copy that number down here. Okay. And then our investment, what else is not going to happen? So these dates are going to have to change. So we're going to have December 31st, 2020, December 31st, 2021, December 31st, 2022, December 31st, 2023, and December 31st, 2024. So we're going to take these out. This is not going to have no interest because originally the reason that that had no interest was because that was on day one, whereas this is an entire day later, or an entire year later, I'm sorry. So this payment is going to be this, go this, plus the 25,000. And so we're going to have our interest is going to come up here. So you can see now that that balances out and that we've got our, and we can run our totals through here, which is what we need for our journal entry. Okay, so those, you can see that our net investment hasn't changed, but the lease payments have significantly increased, and the interest that we're going to earn on the lease has also increased because our required return of 8% will take longer to earn if we don't receive the payments until the end of each year. Okay, so then now it says, assuming that we are using the payments each January 1st, prepare all journal entries. So let's get started with that. So for January 1st, 2020, we're going to have the purchase of the equipment. So we're going to have debit equipment for lessee. Okay, and the cost of the equipment was 415,000. And we're going to have credit cash. Then on the inception of the lease, we're going to receive, I should say lease. We're going to receive our first lease payment, debit debit cash. So our first lease payment is going to be $92,264, number here. And we're going to have debit lease receivable, which is going to be this amount minus this first lease payment, $394, because we received that one. Then we're going to have credit repairs and maintenance expense. Actually, this amount is going to be this amount plus the $4,000. Remember, our lease payments were higher because of the repairs and maintenance expense. And then now we're going to have credit repairs and maintenance. And now we're going to have this $4,000. And then the difference is going to be unearned interest income. And that's going to come right from our schedule here at this total, $71,472. And we also need to take the equipment off because here we put equipment onto our statement of financial position and we need to clear that off. So now we're going to go credit this account here, equipment for lessee. And we're going to take this $415,000 off, one extra zero there. Okay, so that here what we're doing is we're recording our first lease payment, which also includes $4,000 for the repairs and maintenance expense. We're setting up the remainder as our lease receivable, which is simply this less the lease, the same amount less the lease payment that we just received. We're going to have our unearned interest income, which is, sorry, I'm using the wrong schedule, $71,472 up here. This is our lease payment here. There's our $394. Sorry, I'll drag this down so you can see the sum, $394. And then we're going to have the, let's pull this up a little bit. Okay. And then we're going to have the unearned interest income, which is right from our schedule, 71 here. And we're clearing off the equipment for the lessee because we had put it on the balance sheet here or the statement of financial position. So we're taking it off because we've replaced it with the lease receivable. Then during 2020, we're also going to have our additional repairs and maintenance expense. So we're going to have repairs and maintenance. Remember how we said that the lessor pays $7,000? Cash, $7,000. And we're going to have 1231 adjusting entries. We're going to have our December 31st adjusting entry. We're going to have record our interest income. So we're going to have debit, unearned interest income, credit interest income to put the interest income through our income statement. And this amount is going to be right off of our amortization schedule. So let's look up here. So we're going to have $24.98 as our entry. The greatest thing about these amortization schedules is that you can pick up all the numbers right off of there. Okay, that's going to be our entry for December 31st, 2021. So let's go back up to the question, see what else we need to do. So we did all the entries here. So we've done C. So D says prepare a partial income statement, a partial statement of financial position at December 31st, 2020, showing the net investment in leases for VIC. Provide the proper classification and assume the payments are due each January 1st. So a partial statement of, so when it says good form, what we want to do is put VIC or put King's Leasing Company. Just see, what do we have here? VIC. Okay, so VIC Leasing Company. VIC Leasing Company. Statement of financial position. Partial. And it's going to be December 31st, 2020. That's all that good form is where you're putting the name of the company, the statement, and the date. And then we're going to have current assets. We're going to have the net investment in leases. And this is going to be the current piece. So what is going to be due in the next year? And this is simply going to be the next lease payment. So we're December 31st, 2020. So this, sorry, and we're up here in this schedule. So this is going to be the payment due in the next year. Current, and then we're going to have non-current assets. And we're going to have the net investment in leases. And our net investment in leases is going to be this number here. So let's take a look. So the net investment in leases, we're up here. We've taken this, we're December 31st, 2020. So here. So the net investment in leases is going to be this 256, 228 is going to be our number. So we're going to have here 256, 228 is going to be our non-current. So our total, the total is going to be obviously the sum of these two, which is 348, 522. And our reconciliation, oops, down here, we also have to provide a reconciliation of the net investment in leases. So we're going to have the beginning balance after the first payment. And we've got all the numbers right up here. So after the first payment, we've got, sorry, up here, 322,706. Then we've got the accrued interest, which is going to be this number here, 25,816. So our ending balance is going to be the sum of these two things, which is going to be the 348, 522, which is the same as this number here, 348, 522. And we also have to provide the company's net investment in leases, note X. Okay, actually, this is the next requirement. So let's take a look at the question. So that's that, provide the note disclosure concerning the lease that would be required for VIC leasing at December 31st, 2020. So we've done the partial statement of financial position. Now we're asked to provide the note disclosure. So E is going to be the note disclosure. So we're going to have note X, the company's net investment in a financing lease includes the following. We're going to have total lease receivable is going to be this number. It's going to be the total lease receivable is going to be, well, we've already received the first payment. So our lease receivable is going to be this amount here. So our total lease receivable, now we need to look up at this schedule and figure out where we're recording. So we're at December 31st, 2021 in this example. So what we need to realize is that here it asked us to provide this statement of financial position at December 31st, 2020. But here it's asking us for the note disclosure at December 31st, 2021. So we've moved a year further in the schedule. So December 31st, 2021 is basically the same as January 1st, 2022. So our total lease receivable is going to be the sum of all the future amounts, which is going to be, you can see it at the bottom here, 301,883. So that's the amount that we're going to provide here, 301,883. And then we're going to have the unearned interest income. Oops, not sure what's going on there. Unearned interest income, which is going to be the future amount of the unearned interest income. So it's going to be this amount here, which is going to give me 2498 or 45. Sorry, that's not the right amount. Let's do it differently. I don't know why it does that. So strange. So the unearned interest income is going to be this amount here, 45,656. So our total is going to be the sum of these two things, which is going to be, sorry, the net of these two things because we report it net. So it's going to be 256, 228, 227. And then we also have to disclose our future lease payments receivable under the financing lease. The financing lease. So we're going to have year ending. We're going to have 2022, all the future years, 2024. And these amounts are going to be our lease payment amount here, which is going to be 92,294, because that's how much it is each year. And then our total lease payments receivable is going to be the sum of these. Some of these here. Okay. And we're also going to have the unguaranteed residual value, which we're going to disclose in the financial statements. Residual value, which is going to be 25,000. So our total then, total is going to be the sum of these two things, which is going to be 301,882. And that takes us through all of our statement of financial position disclosures. So you can see here we've got the partial income statement where we just provide the net investment in leases. And these numbers are coming right off of our amortization schedule. And then we need to disclose what's included in the net balance. So the sum of these two things is 348. So that includes the beginning balance and then the accrued interest component. In terms of the note disclosure itself, we have to disclose the breakdown, what the total lease receivable is, and the interest income, net of the interest income to get us to the net amount, the 257. And we need to provide a schedule of the future lease payments receivable under the financing lease, and we specifically spell out the unguaranteed residual value. So that takes us through the statement of financial position and the note disclosure presentation. And that concludes this question.